The question is, we have a bull flag. Where's the bull flag?
The question really is, where you're saying it would be, the doji is a sign of neutrality.
Mm-hmm.
And instead of turning around, the market's working off its overbought condition.
Right. Only if it trades sideways for a while.
It's going to trade sideways.
Right.
And in terms of not looking at the candlesticks, but in terms of the Western, now you're talking about a bull flag.
Okay. What he's saying is the market moves up, and let's say we have a doji or some spinning tops, and the market trades sideways. Don't we have a bull flag? And the answer is no. When do you have a bull flag confirmed? When it breaks out of the top end. That's the if-then. If the market closes above the resistance area, then you could use the measuring for the bull flag. All you're doing, it's not a bull, it's like a double bottom. If you have two lows, it's not a double bottom. When is the double bottom? When it takes out the intervening high. When do you have a head and shoulders break? When you break the neckline. Okay? So it's a potential bull flag, but it's not a bull flag until the market breaks out of that sideways, or if it's a pennant and breaks out of the triangle. Okay, so here we have a bullish engulfing pattern based on the bullish engulfing pattern. What would be our target? So we're over here. Okay. That's a great risk reward. Okay. Now we'll look at adapting to the market later, but as time progresses, so that's our target up there on the red horizontal lines. But as time moves on, see what market formed? We have a doji, also a harami, right? Small real body, and a big real body. Nothing wrong at that point with moving up stops. You may want to take some profits also, but nothing says you have to stay 100% long until we reach our target. Okay? So I would use that doji and the harami as a time to adjust stops.
Where would you move them?
At a minimum to whatever the risk is. Whatever my risk was, I would do that to break even. So you're not playing, with that risk again. Okay. The change of polarity. We're looking at candles and Western technicals. So change of polarity. Okay. I came up with the term, but it's a very basic Western technical technique. What happens is old support becomes new resistance. Let me explain why. The market is holding support here. Let's say that yellow dotted line is the euro 123. And it gets down there, it bounces, it gets down there, it bounces, and every time it bounces, traders who missed buying it are upset. Okay, so they buy it on this session here, and you bought at support. Congratulations, you bought at support, right? So this is where religion comes back to Wall Street or to the Forex trading world, because you say, please God, let me break even, and I'll never do this again. And you have dreams like this, okay?
Oh, yes, I did it.
Right? Right?
I admit that.
Right. So what happens essentially is the buyers, once it breaks support, the buyers, once the market breaks even, become what? Sellers, right, because they're thrilled. I mean, it's human nature. You're underwater, you're thrilled to break even. So old support, and this is just one of many reasons why the psychology of technicals works. So old support should become resistance, old resistance becomes support, because people are upset they missed the breakout initially. This is one of my favorite Western charting techniques, works well in all markets, all time frames. In fact, when I used to work at Hutton, when I used to actually follow bond futures, and go back far enough, early 80s, there were Ginnie Mae futures that were so popular. And I used to look at what we back then called tick charts, which was different than what tick charts are now. But essentially, every trade was and it was just a line chart. And I use this technique all the time, just on line charts, tick by tick by tick. Works great in any time frame. So let's look at some examples. And it has to be a support zone tested at least 2 or 3 times, not just one support level, not just a bounce. So here we have a multi-tested support area. Old support should become new resistance. Okay. Some of you may have also heard of an internal trend line. I'm not real big on this, but just in case you come across reference, essentially it's just an angled trend line. And once the market breaks under it, the old support becomes resistance. I'm not crazy about this. I just really like horizontal support and resistance. But just in case you ever come across that expression, an internal trend line is an angled trend line. So here we have, see how old support became resistance. And what was extra ominous, and when I say extra ominous, it doesn't mean the market's going to fall further. It just means the odds of the market turning are higher. Is obviously we had a doji. And that would be a short sale for me because the doji is confirming a resistance area. And what happened on the session after the doji to give us extra confirmation? What three candle lines before the candle line before the doji and after the doji? What three candle lines? What pattern did that form? Mm-hmm. Evening star, right? Even if it's a doji, it's an evening star. What we're going to look at now is one of my favorite indicators is if a market breaks a support area and can't hold it, it's very bullish. Or if the market breaks resistance and can't hold the new highs, it's very bearish. So let me go through this. The first one is the crack and snap. The market cracks under a support level, which should be tested 2 or 3 times. Cracks under it, and then snaps back above the previously broken support level. We could use that to buy. And what you should do is, this you could use an intraday stop. If the market indeed is solid, those lows, those intraday lows, should not be pierced. So you can keep a stop under the low, and your target is the most recent high. In equities, I like to see this confirmed by volume. So if the market breaks support, I like to see it break support on light volume, and when it springs back, the volume increase. But in the Forex, this is fine just the way it is. The reason something like this works, and the reason this works, and I'll go through it, the rationale behind it in a couple of minutes, the falling off the roof, it's the opposite of the crack and snap. The falling off the roof, the market has a very clean-cut resistance area. The bulls push above the resistance area, and then it pulls back under the resistance. Great short sale if the risk-reward is good. Because your risk is to the high of the move, and your target is the most recent low, the pivot low. Now, the reason crack and snap and falling off the roof, and the reason I call this falling off the roof, by the way, is